how can you help them access capital
I mean,
to get that conversion?
Right. To start with, I mean, I'll kind of change the question a little bit.
Okay, please do.
I would try very hard to look at my business model and try to find creative ways to not have to finance or get growth capital.
Hey, what's up, everybody? Welcome back to another episode of Let's Talk Marketing with In-Depth Podcast, where I'm your host, Nathan Webster, and I got my man, Chris Magaña, the money nerd. What's up, bro?
All good, man.
Hey, for those that are listening, y'all got to jump on, check him out, because he's wearing a beautiful, is that a flannel? Because that's not like a shirt.
It's like a overshirt. It's a local guy here, bleached by Josh.
Bleached by Josh, okay.
You know, he's got, the back's got a bunch of embroidery work, and then it's got the flowers for Rose City. Yeah, super good entrepreneur, side hustle in it.
I gotta get
don't know him well, but hope to do some more stuff with him in the future, because I got some ideas for some of the companies that I work with that doing some collabs and some different stuff. But he does all the fresh tie-dye. He's done some collaborations with the Portland Trailblazers and a few other local companies.
Pretty nice.
So he's on the up, if you ask me.
Bleached
by Josh.
Okay.
Yeah.
Okay. So then tell the listeners who you are, what you do.
Protect and grow capital for successful families and nonprofits, and spend a bunch of time in the classroom, and then help entrepreneurs and community leaders create impact.
I love it. So for those that have been watching him for a while, this is his third time on. For you first-time listeners, we know him as the money nerd. Where can they find you out if they want to go check you out?
You mean if they want to stalk me? No, I mean,
of course, that's normal.
Well, at some point, like, I don't know when this is going to air, but I should have a website someday. If my marketing, my Let's Talk marketing guy gets my website up.
We're a little behind. We are a little behind. Yes.
LinkedIn at Chris Magaña. So it's and Instagram if you want to just see me doing silly things or ranting about politics. Running value. It's kind of my handle on
running. I never asked you, what's running value mean?
So I hate the term like financial advisor or like some of these other kind of terms that we use in my industry. I think they're pretentious. I think they're ambiguous. I think they do a good job of trying to keep like a power imbalance between your clients and yourself. So
that's interesting.
when I would usually like introduce myself, I'd say I run money. Right, that's all I'd say. And even that, people don't know what that means. Like,
right, that's what I was like. It's interesting.
You grab cash and you run, because you don't look like a runner. But so I run money, or I run capital. And then I follow the value pieces. There's two. There's a term called like value investing, which has its own kind of philosophy on how you invest capital. And I kind of hold myself out as a value oriented investor. And then the fact that I think later in my career I learned, and I grew appreciation for, if it's just for investment and just for maximizing your own personal wealth, it's not big enough. So value for me also mean kind of values. So it was kind of a nice little kind of double, running value. It's,
I like it.
It kind of touches on the strategy, the tactical approach that I take to investing, but then is also the philosophical, I run money with value. So it's it's the same, it's similar messaging that I say with, when I talk with entrepreneurs or wannabe entrepreneurs, where I tell them, if the mission is just for your own benefit, the mission's not big enough. Like it's gotta, your stakeholders, right? Like it's gotta help your employees. It's gotta help your clients. It's gotta benefit the community, like those kind of things. Some of the things that some of the people in our community, we were talking about offline before this conversation, should listen to.
Oh,
you can bleep that out, or like,
no, we just ain't gonna talk about anything more than that.
Yeah.
But I will
get a couple whiskeys in me, and I might share.
No, you won't share that. You won't share that. But, I will say, when I first started in the business coming up, I was shared an episode of Oprah that said, and this is when I had my nonprofit, is if you kind of going back to the mission statement, if it's only for you, it's not big enough. Well, if you're the only one putting money into it, then it's not serving the community that you're serving. You have to find other donors, find other board members that support the same. And that's when I realized, like, oh, I can't be the only one to just keep funding my nonprofit. And that's what made me how to change everything.
Yeah. Well, I mean, this is, I don't think this was the topic of the day.
It's not, but, we're going to move into it though, but go.
But hold my tea.
You can go on that.
My problem with a lot of that stuff that I see, it's people with good intentions mostly and trying to do the work. But what they're doing is they're doing the work, trying to do the work for the community instead of with the community. So one of the other kind of mantras things that I try to I ask myself when I'm looking at, engaging in a project or engaging with a client is, I want to approach it from the standpoint always with community and never for community, right? Because then you got savior stuff, and then you've got, if my check stops coming, does the project fall apart? Because again, it has to be bigger than you, right? It has to be bigger than what you're working on. So like for me, like when you approach these projects and business relationships, economic relationships, it's like, you have to approach it from the standpoint of, always with community, never for community. Because the for is just, again, it's just this approach where, you're potentially the savior, you're, trying to, I think it's why some people tithe at church. They're like, I'm going to put my money in the offering, and then I'm going to go, yell at my wife, kick my dog, and slap my kids. And like,
yeah.
And then, but I'm good because I threw a 20.
Wow.
But anyway. When they say like never talk politics, religion, I break all those rules all the time.
They say politics, religion, and music. Those are the three that.
Oh, music. Yeah.
I heard you can start some. That's what. Ever since I was in middle school, junior high, Y East, someone brought that up, and I was like, yeah,
that's probably true. That's probably
music.
True.
Yeah. That was back before though. That was back before when we had our own devices. And you could listen to your own music, but I was in the Marine Corps. If you start playing some country, and it wasn't the agreed upon time where we were supposed to share.
Yeah. Well, I mean, I struggle with. I was with a friend who claims to know music, and he's like, Drake totally beat Kendrick in this rap battle, and I'm like, okay, you're not a serious person. We can. I mean, you can like Drake all you want, like to say that he.
Yeah.
Just too much. So like, the music thing, like maybe that's why I'm gonna start using that. I'm gonna say, we'll talk religion, politics. We're not talking music.
Yes, I know, because I have a buddy, and this is a good transition to say that some the music is now just what did he say? Something like it's just reverb, just repeated. It's not original, or you can't understand them. And I think that's where in this new era, in this new industry of music and how we go about creating businesses, it's hard to be original and to figure out what is going to work and what's not. And so I wanted to have Chris on to make this turbulence a little bit smooth for the transition of when people start a business or they're growing in their business, they're looking for funding. You want to keep your originality, your authenticity, that value proposition, and how that unique from the USP. There's lots of different ways to say it, but in order to grow, it's going to require money. So I asked Chris because he's the only investor that I would trust to bring him onto the show, talk to y'all about what does that look like if you want to get investment, or if you want to stay private, what is the right way to get capital for your business? And break that down, because I'm about to learn here too.
Man, like
I know this is only like for so long.
Yeah. I mean, you could have a whole 2-year course, degree on this topic. So I'll try to summarize as much as I can and give you some quick tips.
Right. I got you. I know you're not going to write a book here.
I mean, the reality is, like, you hear young starry-eyed entrepreneurs talk about, like, I'm going to go public with this company someday. I was just talking with a shoe company the other day. they're kind of like a poor man's crock, and they're like, this is a $1 billion brand. We're going to we're going to go IPO. And, you know, the reality is, like, it is a fraction of a fraction. You have a better chance of being a K-pop star than you do of IPOing. And the market has changed so much because the market used to be like, kind of the curve of the growth of a company was, you start something in your garage, you prove the concept out, you start selling it locally, you bottleneck because you don't have enough capital to kind of reinvest in new equipment and new product and all that stuff. So then, you find some friends and family, or you find
angel round of investing.
You do some angel investing. You get some local rich guy or gal to like write you a couple of checks. You get to the point where, maybe you have some infrastructure, right? Because banks, for example, typically won't invest or won't lend you money unless you have infrastructure, because they want something to repossess if it goes wrong. So if you're a guy and a gal with a website, there's not much to repossess there, right? Maybe some intellectual property, maybe the domain name, but there's not a lot. It's not like, you're the local HVAC company that has 10 trucks, a bunch of high-end equipment. They're like, okay, I can finance that. So, walking into your local bank to get growth capital is typically it's a low probability thing. So you have to rely on, investors that have, maybe had some success before, wealthy, they've already created wealth somewhere else, and they're willing to kind of put some capital at risk in something like that, where they're not getting kind of collateral and things like that. But then once you kind of, getting back to the story, like once you kind of get to that point where you've got some funding, you're getting the local dentist or physician to write you a few checks, you're going to tap out from there at some point, because they're not going to keep writing you checks. And there's only so many, crazy doctors and dentists and lawyers and retired executives that need something to talk about on their golf course to write you checks. So then you got some issue. Like, you can go, and the traditional model was at that point, then, you start to look for maybe going public. But now the markets have changed so much. Like, if you actually look at the number of IPOs, initial public offerings going to market, I mean, it ebbs and flows with the overall economy and interest rates and some other things, but the trend is down because the markets have evolved to the point where there's a lot more wealthy people willing to write checks. There's venture capital funds, and there's funds that are specifically niched now for growth capital, and more and more companies are choosing to stay private because there's plenty of liquidity for it now. So this is why even in the public market, so when I first started in, my day job, when I first started, was investing in public stocks, right? Stuff that's traded on the New York Stock Exchange, the NASDAQ, that kind of stuff. And there was 7,000 or 8,000 individual companies listed on those exchanges.
You said 7 or 8 or 700?
7,000 or 8,000 companies.
Oh, okay.
Right? There's now like 3,000, 3,500. So the number of companies that are choosing to go public and stay public is going down. The costs are higher. After the financial crisis, we had a bunch of fraud with Global Crossing, Enron. And so there's some legislation called Sarbanes-Oxley. And it raised the cost and increased the liability for executives that are public. And so companies, and then you have at the same time this innovation where there's all this growth capital now that says we'll give you capital, and you don't have to go public. Like, we'll finance you. So the reasons to go public have kind of diminished, and the costs have increased, and the risk exposure has gone up. So there are more and more facilities now for you to stay private. So the other reason why companies would go to private is, you think about, like, you've got this small team, they've been with you since the jump. They own a bunch of the company because you paid your programmers peanuts, but you gave them equity, right? And they were taking the risk along with you. And so the other reason why traditionally companies would go public was because at some point, these founders and co-founders and early employees wanted an exit, right? They're like, okay, I'm worth $20 million of this company's stock that's not public, and what am I going to do with that? It's all on paper, right? And I can't pull it out, I'm still not making a ton of, I'm not making what I was if I was a managing director at Microsoft or Google or some other. But I'm worth a pile of money on paper. So a lot of these companies would choose to go public so that they can monetize their personal, 25, 50, $100 million stake in this company. And then they could start selling some of those shares, right? So that was the other reason why it was really more of like kind of a succession and family planning, and then just accessing their own capital, right? Because we know, when fancy rich people exit and get, they start building rocket ships and start doing silly things, right? And they start getting yachts bigger than, Rhode Island. So, but you can't do that if you've got $50 million worth of company stock in a private company that has no market, right? You don't really know what it's worth. So at least, you may not like the price of Nike stock today or Google stock today, but you know what it is. The scoreboard doesn't lie in that respect.
You talking about, what the company is, or what the value of the stock is?
Well, you know what your personal stake's worth if you've got, because it's trading every day.
Yeah.
Right. And so,
Okay.
so you're, when you're in a private company and you've got, I've got, X number of shares in this private company, you're not there's no way to really tell you what that, there's a lot of guesswork and a lot of, you can have audits done, but you're not having audits done all the time. And really, you're probably only having an audit done or evaluation thing done is if you're trying to raise more money or you're trying to buy somebody out or something like that. So that, how often is that? I don't know, every year or 2 years. So you're kind of flying blind with like what your net worth is. So it's illiquid. You can't diversify it. So sometimes companies back then would choose to go public so that they could diversify their own net worth, right? They could, if they're worth $100 million in this one company stock, now they could sell half, still have half the stock for voting and other stuff, and show that they're, eating their own cooking by staying invested in their own company. But that other 50 million, they can go buy calf implants, yachts, rockets, invest in other stuff, or just, buy other investments, right?
Right.
So
and just for people that are like, okay, what is Elon Musk doing by not taking a salary and only having stock options?
Oh, there's a whole bunch of stuff to that. So
I guess I don't want to get you off the tangent.
Yeah, no, I mean, so the other thing is when you getting paid in stock, actually favorable. And this is, if we're going to put on our social justice warrior hats on for a minute and talk about some of the ills in society and the wealth gap. I mean, I think I could probably fix the wealth gap in pretty short order. All I would do is I would tax capital at the same rate I tax labor. Right? So if you make $1,000 working on my website, for example, you're taxed at a higher rate than if I issued you stock and then it went up and you sold it. So the max you're going to pay on if you sell stock at a gain,
the capital gains tax,
its maximum is 20%.
That's it?
Yeah. If you're a high earner, if you're wealthy but you're earning all of that through income, and you're in a high tax state that has like an income tax, like Oregon, for example, you could easily be paying 50% in taxes. And then,
oh wow.
And then if you look at what like Elon Musk and some of these people that have huge stakes in these company stock, what they do is if they need money, to buy a yacht or a new rocket or whatever it is you're working on, a new gold chainsaw that you're going to go on stage with or whatever, you don't necessarily sell the stock and pay the tax. What you do is you borrow. There are banks like Goldman Sachs and other Wall Street banks that will say, hey, you've got $100 million worth of this company stock in Tesla. If you sell it, you're going to have to pay $20 million because you got zero basis, for example, right? In this example. Why do that? Because now you're only going to have 80 million of value to actually spend or do whatever you want with. Why don't we just let you borrow against it? So we'll give you a loan at a super low rate as collateral as the Tesla stock. So you still own the stock, and if it goes up, you're great. Like you're even better off, right? Because now your 100 million turns into 200, and you only borrowed, let's say, 50 million against the company stock. right?
Wow.
I mean, the only way you get in trouble with that is if the stock goes down and then the bank says, well, we want some of our money back. Now you might have to sell some of the shares. Like Jeff Bezos, Elon Musk, and when they have these big stakes like that, they often borrow against their stock instead of selling. Like I needed a new roof put on, right? I had to sell some stock to do it, right? So I had to pay 20% capital gains. But if I had more zeros in my portfolio, I could have called Goldman Sachs and said, "Hey, give me a loan. I don't want to sell my Google shares, Alphabet. Give me a loan against some of those shares for my new roof. And then if, I'll keep the stock and I'll just pay the interest, this favorable interest rate on the stock." So there's all kinds of tricks and strategies that you can do. But again, you've got to have, not 6-figure, not 7-figure, like 8-figure to really start doing it. There's also companies that will help, like minimum like 25 million, and it's probably increased more than that now. But if you have like 25 million in one company stock, what you can do is they will essentially do a tax-free transaction where they'll take the stock from you and they'll give you a diversified portfolio of like an index of S&P 500 or something like that and replace it. And they'll do it in like an LLC structure. It's complicated. The IRS has kind of like, I mean, I think there's only 3 agents left at the IRS because we pretty much cut them all. But the few that are left, I think they've sniffed around this and said they're not comfortable with it. So, but there's all kinds of strategies that, but again, this stuff is, you've got to be on some Forbes billionaire list to
Right.
really
It's
start
for the
deploying
less than
them.
1%.
Yeah.
Okay.
For the rest of us, common folk, that are, that drove ourselves to this meeting, that get our own Starbucks, that those things.
Right. Right.
Growth capital is, it's still a good time. It really is, because there are more avenues than ever. I mean, I think shows like Shark Tank and other things have really kind of put out there the power of entrepreneurism, and really showed like there's opportunities to kind of start businesses. So I talk with people all the time that are growing businesses and finding kind of different ways to fund that growth, right? And so there's always the traditional sources like small business loans, which kind of are expensive and pretty limiting in how they approach. And what I found too is that if you've got somewhat of kind of a creative business model, um, the small business kind of loans and the traditional loans from your bank or credit union, they kind of like, they're probably not the right fit. But again, there's now this whole layer of these venture capital funds and private equity that are willing to fund these things. And for the entrepreneur, the problem is, how much of the company am I willing to give up? And what kind of interest rate am I willing to pay if I'm doing debt financing? Because that can be a real challenge, right? And that's where you need to have a good advisory board. You need to have a good, financial folks on your team to help you make those decisions. Because like there's one deal that we're working on right now, for a startup media company that focuses on like Latino and Black and female, showcasing kind of the business activities of these group, and like just really cool stories. And we needed some growth capital, 400,000 or 500,000, and the company that's willing to help us, we'll round up the capital for you, no problem. They want to take a piece up front, which is that's fair. They're doing the work, and there's going to be some debt component where we're paying interest on it. Fair, and the rate was fair given kind of the interest rate environment we're in. But they also wanted a piece of any royalties for life. So and that, if you look at companies like MGM and these other companies that just sold for like a huge amount of money to Amazon, and if you look at Marvel when they sold to Disney, and if you look at what was the other one that they did? Oh, Star Wars. They paid a couple $1 billion for Star Wars. There's no way that the current kind of revenue train that those companies, the content of those companies, 6 Star Wars movies, 3 of them not very good and 3 of them awesome, like, were worth the money that they paid for it. But what did they do right after? What did Disney do right after they bought all those companies, all that content?
They put it on their channel.
Yeah, they put it on their channel. but they spun up how many spinoffs and how many different, right? And then they started launching parks, and they started launching merch and Lego collaborations and every collaboration you think of, right? So they spun
license it out.
So there was no way in the current form that content library was worth what they paid, right? But once you spin it up and you start spinning off all these different series and stuff, then it's worth it, right? So they did that with Marvel. Look at how many Marvel movies. Every movie comes out, it's a hero movie now, right? All the content from Star Wars. So anyways, back to the story with this media company that we're working with is, giving up lifetime, and it wasn't a small percentage of the stream. Like for us, that was, that was a no deal. We needed the money. We didn't need the money that bad.
But for the work, you talk about the royalty part.
Yeah. So again, we were willing to pay up front. We were willing to pay a competitive interest rate. We were willing to even give a limited amount of a royalty stream for a term that expired, but not lifetime. Right. Because the same thing you're going to see with MGM and Amazon. Amazon's going to roll out, because I think they own like the James Bond series, some of the Tom Clancy kind of like spy thriller stuff. So they're just going to start spinning out a bunch of that stuff. And that's how they justify the huge price they paid for MGM Studios. So it's not in the content game. It's not really about what you're not paying the price for what you're the current revenue generation off those. You're paying for, I've got these known characters and heroes that have a built-in audience that all I got to do is spin up 10 different prequels, sequels, side stories. The third character on the fourth movie now has his own series or her own series. Like that's the value, right? And so in media space, when you have these iconic kind of characters, I mean, there's a Smurf movie that just dropped again. There's the Barbie movie, like those kind of things. Like, and then if they're in that era where you can cross sell merchandise and toy lines and theme parks potentially, like all that stuff, right? So, anyways, like. I know we got off track a little bit with that, but that is one area where there's now all these facilities in place and these helpers that will help you finance growth. But you have to be really, really smart about who you're working with, their integrity. You have to be smart about the deal that you make, because a lot of the deals that I see, they're very lopsided to the investors. And that, the investors that I know would argue, I'm the one taking all the risk. I'm the one that doesn't have control, because the entrepreneur could do anything with this capital once I give it to him, really. And so I need to be compensated by taking a big chunk. Well, the problem is that I've seen deals where they take it, the business, the growth maybe slows a little bit, economy slows, something slows, and then all of a sudden now they've got to cut in staff. They've got, to do things to the business, which they didn't want to do because they leveraged up too much. So being really smart about how you finance the business is important, but just realizing that, the IPO path is, I think here in the Northwest, we've had 2 or 3 in the last several years. Like, it's such a small piece. So it's always kind of interesting to me. And it's probably not nice of me and not fair, but I do, when I see a young entrepreneur that has kind of zero revenue and some expenses and this $1 billion idea, and they're like, yeah, I'm going to IPO this thing someday. I'm like, you're probably a little immature, a little naive. You haven't really baked this idea. You still may do all those things, and God bless you, and I'll pray that you do. But you're probably not that sophisticated, and you haven't really some maturity to it. Because if you were smart, if you knew the space and you knew how finance worked, you know that there are lots of other avenues to finance the growth of your business for decades, really. And then the IPO market is just something you don't necessarily need anymore. And then even if you do, very few, even very successful company like Les Schwab here on the West Coast is huge. Like, they do billions in sales. They never IPO. They don't need to. They self-fund. They have an employee ownership program. They
really?
They don't do it. Yeah. So like, you can be a huge company and massive amounts of profits,
impressive,
and never go public, right? So the other thing that we're seeing,
I do miss their beef though.
I know. Where's the beef? They used to do that. You buy your tires, you get it. But it's so quirky, right? I love that. I love that kind of, I always say niche weird. I love that. Where it's like, you got to have a niche. Your niche has got to have a niche, and then you got to do something that's weird and different.
Outside the box.
Yeah.
Yeah.
You were talking about how, companies they all kind of look alike, and they all kind of behave similar. As an investor sits on that side, I sit on both sides at times, right? Sometimes I'm the one begging for money, and sometimes I'm the one writing checks. It's very humbling. It is very humbling. When I'm on the side potentially writing the check, it's amazing to me how many pitches you see with like, we are the Netflix of this. We are the Airbnb of that. We are the subscription Netflix model of socks or toothpicks or whatever. We are the Airbnb of power tools or whatever. Like, there is all kinds of it's I get it from a marketing and from a storytelling and from I've got 5 minutes to impress this investor group, and they got to write. So how do I get some massively successful company in some other place? Okay, we are that of this, right? Or the other funny one, we were talking about this at a venture thing the other day, which there's companies that we looked at a year and a half ago, and they had a business model in whatever tech or apparel, and nowhere in this pitch deck was a term like AI. And now, if you see their pitch deck now, AI shows up 66 times in their pitch deck. We see that across the board, right? And 5 years ago, it was crypto.
Yes.
I had a lemonade company, right? That's about as far as you can get away from crypto. That their deck before the crypto craze was, we're a lemonade stand, organic, farm direct, whatever. Post that, it was like, we're a lemonade stand, farm direct that has a crypto component with a coin and da da da.
But you can pay with NFTs.
And crypto was in their slide deck a bunch of times, and it was like so much of this it's a lemming thing. It's what's popular, what's hot.
So much hoopla to it.
And in some ways I do understand, because your investors, especially the not sophisticated ones, if you're talking to that rich dentist or that retired executive, and he doesn't understand crypto or doesn't understand AI very well, and you come to him but he's seen the recent success and the recency bias of how that space has grown, and you come to him with like, I've got an AI play, or I got a crypto play a few years ago, like, all of a sudden, well, yeah. I like money. I like making more money, so I get it. But
that's just, what's her name, that was like the next Steve Jobs with the whole blood.
Holmes, yeah.
Thanos or something like that.
Great book. If you haven't read it, Blood Oath. Great book.
Really?
Yeah, great.
About her, or she? Oh, okay.
The whole story, like, in depth. There's also a series, I think it was on Hulu, that was pretty good.
Okay.
But the writer of the book, Wall Street Journal, long time, I think his name starts with a C, but a long-time writer for the Wall Street Journal, did a really, really good job with that book. Also very good audio. It's a good audio read. Like, not all books are good audio. Like, some books I choose to, I want to read this in paper.
Okay.
And some I'm like, I don't want to read this in paper. I want it the audio version. That's one that's a good audio read.
Okay. So, no, that was one that got me interested of how she raised so much money. But like you say, like, it was the play on biotech.
Oh, and it was, there's something about, she had so many wealthy people and influential people on her board, and who were part of her advisory committee. Rupert Murdoch from
Fox,
the former Secretary of State.
Yeah.
That there's some validation, and we see that too with capital too. Even there's a project we're working on in Portland, that it's a lot of it is, who do you know still? And, this is like probably a $15-20 million, like, they need about $20 million in capital. And they're specifically putting people on their board because they know that they have influence with some money that they want from, like, some government funders, and then also from some key companies in the space. So it's all kind of backdoor kind of, it's not shady. It's just kind of how stuff gets done, right?
Yeah, it's business.
If you've got a cheerleader, on your board that is going to go, has access to fancy people that write big checks, and, or the right people at some big company in your neck of the woods, and can get them to write you a check, like, it's not shady. It's kind of a bummer for those of us that didn't grow up in the country clubs. And if we did, it was because we were carrying the golf bag. But I get it. I get it.
Yeah.
Anyways,
Backcountry Club. Yeah. Anyways, I won't get started on that. Because we've been talking for a while, and for those that are listening, watching, make sure you comment below. If you haven't subscribed, please do so. I'm trying to have Chris on even more because I think, especially, no. Because I just want to segue to a couple of things before we end, because when I'm talking to people about their funnel and I want to help them tell that story, as he was saying, you get their attention, but now we have such a short attention span. You trying to raise capital, and I don't know if he's still the back in the day, the best practice was to have a 9-slide pitch deck with very few words, if any words, pictures. And you have how, if we move down the funnel, if I just get straight to the point, if we're getting the marketing to the sales to conversion, how can you help a new business or maybe existing business that's looking to grow? How can you help them access capital
I mean,
to get that conversion?
Right. To start with, I mean, I'll kind of change the question a little bit.
Okay, please do.
I would try very hard to look at my business model and try to find creative ways to not have to finance or get growth capital.
Ooh.
And here's why.
That's a diamond.
Once you start by getting capital like that, it can be expensive. It can limit how you operate your business. And then again, even in that example we were talking about before the show started, where that their funder, their investor, in this case, it was a good thing, but said, if that key employee stays, that co-founder stays on, no more checks. Right. So they can start running your business. Right? You say, well, Chris, they don't have the voting rights to do that. It's not what's in the, yeah. But if you're relying on their checks and they say, you're going to do this or else the checks stop coming, they don't need some voting proxy to throw you out of your own company, or make you change directions, or stop sustainably sourcing your product.
That's what they did to Steve Jobs. They fired him from his own company.
So you start losing control of your company, right? And a lot of times founders and co-founders and like early employees, they're there for a reason. They're there partially. I don't buy the whole thing that they're there to change the world. Like, they're there to get rich. They want a vineyard in France. Like, stop it. Like, just stop being performative. Like, don't. Right. But there is an element of control, and there's an element of they probably weren't the optimal person to be in like a corporate cog. They're a little quirky, right? Even Steve Jobs, he wouldn't wear deodorant. They had to make him work at night when he was working at Atari because the guy smelled bad and the guy had no social skills, right? He was not meant to work in a corporate confinement structure, right? And a lot of times these entrepreneurs they're not really designed for that. So once you start being too reliant.
I'm sorry.
That's another great book. Go read it. He was a character, like, he was incredibly successful visionary and product guy and all that stuff. Really, really flawed human being. Really flawed human being.
Interesting.
But anyway, sorry.
Sorry, y'all.
So one of the things is like, and there's you're seeing really creative ways for companies to get capital that it's not dilutive, in the sense of, it's not, you're not issuing more shares, which, dilutes your value in the company. It's not losing control in the sense that now the banker's sitting on your board, or the investment brokers on your board now. Like, even think about, like, look at how many of these companies now are doing like pre-sales of things, right? So it's genius. You're like, so there's a company that I love their product. I got probably 50 of their hats. They do it takes like 6 months. So they put a design, they do like some design competitions. It's all kind of black and brown, founders like doing really cool designs. They put a whole story about the hat. And then you give them your $60, and then in 6 months you get your hat. They don't need growth capital from any bank or any investor, the rich guy or gal in their community, because I've bankrolled their company by giving them a 6-month loan of that $60. Me and the 10,000 other people that buy into the system, right? So like, look at your business. I would say first look at your business model and find ways to grow the business and for growth capital without giving away part of the company, or without borrowing money at some high interest rate that you got to make a monthly payment, where if the economy changes, sales slow, tariffs hit, all of a sudden you can't make that payment, and now you're not in control of your company anymore, or the company is now in a weakened position. So
Right.
there are lots and lots of creative ways. There's a lot of like non-dilutive grants that and what that basically means is there are organizations, quasi-government, oftentimes, sometimes private foundations, that are looking to keep companies in their area, or want companies that are going to grow to be the next big company.
Mm-hmm.
And so they'll give you capital. Just that doesn't take away your equity. Like, it's kind of no strings attached, because they want to see you succeed and keep you there. Or if there are strings, the strings are like, hey, you got to keep most of your employees here in this market, right? Because they're there, again, if they're like a quasi-government agency or something like that, they want to see that you're maybe revitalizing a neighborhood, your office is in, a part of town that maybe is a little sketchy, or that if you're hiring employees, you're going to do it in that state, which is going to mean they're going to get payroll taxes, and then you're also going to support the community, because, when you go to work, you go to the coffee shop, you go have lunch, you stay in that area after work, and, play video games, pool, whatever it is you do, right? So all that economic activity that happens. So there's a lot of like private foundations and private and like government agencies that have non-dilutive, like, will write checks to keep companies in that area, right? So I would look for capital like that. I would look for any sort of way to do some sort of pre-sale. There's Kickstarter's been around for a while, like that kind of stuff.
Yeah.
There is, or finding if you're in more of a niche specialized business, maybe you find a customer that is like a large multinational corporation. You try to solve one of their problems. And so, like, okay, in our neck of the woods, let's say it's Nike. I'm just making this up. This is not a real example, but you go to Nike and you say, look, give us a few $1 million. And when we get this new synthetic leather, you'll have exclusive rights to it. Right. And, for Nike, $3 million is, a drop in the bucket. Like, so like finding ways to do partnerships like that. There's a company in Colorado that kind of the guys and actually they were all guys. Sorry. They came out of, the parent company that owns, North Face, and,
okay.
And North Face just wrote them a big old check, because they're like, we love what you guys are doing. We want to be a part of it. We're sad to see you leave, but here, take our money. Right. So like getting creative about those kinds of things. And I get, not all of us are going to have access. We didn't all C-suite at North Face and we're going to have that check, but I promise there are ways to get more creative with your financing that don't involve giving away your company or subjecting yourself to personal guarantees, which we didn't talk about. Because a lot of times for growth companies and small businesses, all of a sudden now your family's financial position is on the hook. If anything goes wrong in your business, like, Chris, nothing's going to go wrong in the business. You tip and fall on your motorcycle. You have a heart condition. You have a divorce. You have anything pops up. So like any kind of capital that you can raise that outside of giving away part of the business, in my mind, is much safer, much better capital. So anyways, that's what I got on that. We could talk about this for literally hours, but
because when it comes to lead acquisition, a lot of people want to say, I want to serve everybody. It's like, no, you can't serve everybody. When it comes to looking inward, when we talk about capital or any capital growth that you want to go, I think part of it for me is helping my clients understand that your story has to be compelling to attract whomever is going to cut you that check.
Yeah.
And I think that's the part where they're like, well, it's not for everyone. But it's hard to tell people that are so married to what they think is the right thing. So that's why I was like, let me get the expert on here.
Yeah. Yeah. The other thing we didn't talk, so I talked a lot about like external ways to kind of fund. The other thing that
internal marketing, but internal.
Well, there's internal, but the lifetime value of a customer is a piece where I've seen really clever, smart companies that need cash. Like if they could look at their own business model and say, man, our average customer stays with us 6 months or 9 months.
Yes.
If we can get that
to
15 months, What do we have to invest? What do we have to change about our process? What do we have to do? And what are the costs associated to get that lifetime customer stay for 15 months? That so much of that just falls straight to the bottom line.
Yes.
Right. And so like getting creative about that process and being real honest, because a lot of times it's because you need to have a better mousetrap. Like you're not doing something right. You're not, but man, it can change the financials of a business. There was a business a few years ago, very similar to that we did a little work with, and we got them through just some better practice, some better customer service stuff, some coaching, some training with some of their team. Like they increased their lifetime of their customer by about 4 months, and it added $1,000 to the bottom line because
wow.
think about all the in that case, if I remember right,
have to use that.
If I remember right, they had big upfront commissions for the salespeople, right?
Yeah.
They had all the costs of onboarding, which it takes a lot of time to onboard clients.
It does.
And then you're spinning your wheels a lot trying to discount at the end. Client, please don't leave at the very end. When if you just had a little bit better offering, or you understood your customer a little bit better, or you niched to have the right customers, you keep them a little bit longer, and then all of a sudden a lot of those costs get lowered, and your sales guys and gals can focus on new business, like true new business, and they're happy because now all of a sudden I don't got to hunt as hard because I get fed for 15 months instead of the 6 or 7 to make their nut. Right. And you're onboard, you don't need as many onboarding folks because you're onboarding more profitable business and not as frequently. So there are lots of ways. I think a lot of times businesses just really have to get smart about thinking through their business and thinking through what's going to be the right way for them to have finances available for their growth. And a lot of times it's not necessarily walking into the Wells Fargo saying, please give me some money. That just doesn't. And again, the IPO thing, very few. Like assume you are not going to IPO because it is such a small handful of companies that actually do that.
Like that's thinking you're going to go and get married at Disneyland and the fireworks are going to go off. You can pay for it.
Yeah. I mean, the reality is I have a better chance of being in the NBA. I'm 5'8" and overweight and a bum knee than these companies, than some startup company has of IPOing.
Oh,
yeah.
Oh man, this has been good because I think the last part Chris was talking about in the marketing world, we call that the CAC, the client acquisition costs. So from the LTV is something that I start having a very real conversation with my fractional CMO clients, because that changes the whole dynamics of the business, because that's operations, that's longevity. That's also talking about your exit strategy of how long you plan to stay in the business, because I think to that very point, to make your employees happy will make you as the key decision makers happy. And if you got any investors, that's going to make them happy. I think that sometimes doesn't get discussed much further down the line when it should be having those conversations much earlier.
Yeah. And I'll tell you, like, if you find the right investors, if you get to that point, you've done all this other stuff. There's no more non-dilutive capital I can find from, city, governments, private foundations. My business model is my business model. I've tightened up where I can.
It is what it is.
I do need some growth capital. Like finding the right investors can be so helpful. Like so many of these brands that we know today are where they are because the investors, gave them capital when they needed it, gave them capital when they probably shouldn't have because they hit hard times, and then created opportunities because, these guys or gals came out of General Mills, and so they know the food consumer space, and they opened the doors for them to have acquisitions through, some of these bigger brands, right? So like finding they're called strategic investors, like finding the right strategic investors who aren't just going to write you a check, but also have some expertise, have some insights, know the industry, can kind of bless, going back, and it was in a bad way, but going back to like the Theranos thing where like she got away with what she got away with because she had so many powerful, influential people as
At the
investors
table.
and on her
Mm-hmm.
board, right? So use that for good, right? Use that for good, you know, and good companies do that all the time. They have smart people that know the industry, you know, and so they're already thinking that 10-year plan of like, yeah, we're going to build this thing up to a point, and then we're going to sell it to Microsoft or sell it to Nike or sell it to so.
Yes.
And so what they've done over that 10-year period is they've strategically incorporated either investors, board members, key employees that have access and influence and know the Microsoft way or know the the Nike philosophy on that kind of whatever it is that you know, so that they have not only talented people on their boards, committees, and employees, but they also have the influence that can open the doors for when that sale happens, right? Because that's the other thing that we didn't talk about, and I know we're over time, but oftentimes you see some of these companies sell because they hit the point where IPO is not realistic. I've tapped out even Goldman Sachs, or I don't like the cost of the capital anymore. The right thing to do here is sell to a big company that can borrow lots and lots of money to really grow this brand and turn this $1 billion brand into a $10 billion brand.
Okay.
And so that's the other reason why a lot of companies do decide to sell too. The ones successful ones is because they're like, okay, I've ran with this thing as far as I can. My team and I'm an entrepreneur, not a caretaker of a company that's huge. And so we've got to that point. Capital's getting more expensive and hard to find. The right thing to do is just start picking up the phone and sell to like a massive big company. And that's going to be best for the brand, best for the customers, best for the employees. And so, you know, you see that too.
Okay.
But again, that process, the wheels get greased if you have people that those big companies are familiar with, people that maybe have worked at those companies or have done business with those companies or have sold other businesses to that company. And so again, the 10-year plan should always be like, how can I get the right people? And the right people is not just integrity, really good at what they do, but it's also, do they have some influence or sway with some of these, you know, strategics that they might sell to?
What was they saying? If you want to loan, the 3 C's: character, credit, character, credit, and oh shoot,
Credit.
but I want to. Oh man, because I want to end on that. That was.
Oh man, you just ruined the
I
moment.
sure
He's gonna
did.
edit this out, right?
No, I'm going to keep
Oh,
it
you're
in
not?
here to keep it real.
Oh shoot!
What are the
Okay.
3 C's to
So
get
like,
credit?
you want me to tap dance while you figure this out? Like, so there's one time when I was a boy, like, no, I like lavender scent. No, yeah. So I don't know. Maybe I guess I'll keep talking.
You should tell them where they can find you at if you need an investor. Could you be a potential?
Oh, maybe.
Yeah.
But I don't need to be inundated with that because I got plenty of checks to write and not enough checks could be depositing right now. Yeah. Why are you looking for me anyways, you stalkers? Like, leave me alone. I'm on LinkedIn pretty often. You can find me at Chris Magaña. Eventually I have a website. Instagram at
He's good. He still owes me stuff, by the way.
It's on me, I know.
But we are behind. We are behind of our promised deadline. You know, I'll keep it real. Yeah. But the 3 C's.
Save it for the judge.
We are behind. We're behind. Character, capital, and capacity.
Okay. Yeah. Okay.
Yeah. So I always think that's interesting because your character is part of your brand. The capacity is you know, obviously how can you make it, you know, the bandwidth, can you make it, you know, if I always ask my business coaching clients, what is your sales goal for your company? Do you share it? And though that's interesting because when you have the business model, you may not have the capital that you may need because you might not even have that discussion. Coming back to one of our last podcasts, we don't talk about money. So we don't talk about money enough. So that's why I wanted to have Chris on here. So for those that don't know where you're at and they want to stalk you on social.
I told them while I was dancing, filling time.
You were. Look at that. Look at that teamwork. Look at that teamwork.
Dream work.
Hey, that's what's up. Well, thanks for coming on.
Yeah.
It's
always good to see you.
Always. You got to come back.
If you want me or if they don't ridicule me too much on the socials.
Yo, hey.
I'm just better looking.
Hey, you got less melanin, for we have to change it up for those folks that like say like, oh, he's too dark to look at.
Who says that?
No one. I'm a nice caramel. I love my melanin.
You're like a chubby Michael B. Jordan.
Chubby Michael. Hey, I'm either
you're Michael B. Jordan before he carb cycles.
That's okay. I still take. Hey, Michael, let's do a lookalike contest. I think I got you for when you need those stunt doubles. Yeah. I'll be that person for you. Hey, thanks for watching. If you love any of it, please like, please share. Also, comment if you haven't already and subscribe. Until next time, thanks, Chris, for coming on. Wish you the best.
Thanks, guys.